I don't know how familiar you guys with us, but we focus on the Delaware Statutory Trust structure within the real estate kind of syndication world. So I could, address anything that you guys might. I don't have to dive into necessarily a presentation, but if you guys want an overview on that, or if you have specific questions, if you already kind of have a background on it, I don't want to waste anyone's time. I want to, make it as valuable for you guys as possible.
Well, we've had the gamut. Occasionally we have somebody that's got a slide presentation and it's very specific, and then sometimes it's a mixture of a little bit of that and a Q&A, and then sometimes we just informally talk about everything. So it sounds like you're up for anything, Chay. Am I pronouncing it?
Yeah. That's perfect. Yeah, Shay. It reads like Chay, but it's Shay. So
yeah. Okay. Got it.
Yeah.
I get all the time now. My last name is Weiler, and everybody says Wheeler, and I just tell them it's German. Call it Budweiser? No, it's Budweiser. So it's helpful to get people to remember that. But I think I don't. Well, I guess I will speak for the group. I've been with the group for a while now, but anybody could speak differently. I think most of us are familiar with Delaware Statutory Trust from two different angles. One is a vehicle, usually as like a 1031 into a Delaware Statutory Trust, and the other as purely a structural vehicle, usually as an alternative to a series LLC for California people that want to avoid the franchise tax. I assume yours is the first.
Correct. Yeah.
Great. Me personally, I have a decent understanding of it. I'm a little curious about. I know there's some structures where people can 1031 an existing property into a sponsor who has a Delaware Statutory Trust, and then after a certain time period I think it can convert into a REIT, and then maybe even some of your principal can get pulled out, without being taxed.
Yeah.
I'm a little bit fuzzy on the exact details of that, so if you've got a little more, that might be intriguing.
No, we can address the kind of 721 approach that you're referring to.
Yeah, and also just purely what hey, look what you've got to offer, and see if it might intrigue some of us in here.
Yeah, so
I was going to say that some of us may not have quite the depth of experience that Chris has in the DST world. So if you wanted to provide a little bit of background, it might be helpful as well.
Yeah.
I may be alone in that, but
Thank you.
Well, I mean, I know what they are, but I don't know that I have the knowledge that Chris has about them either.
Yeah. No, I'll give a quick kind of structure background on the DST, and then I can first address what Chris was mentioning, and then we can kind of open it up to other topics there. But
I'd say that I'm right around where Chris is. The UPREIT stuff is the stuff I'd be most interested in.
Okay, great. Yeah, so to start, the DST is an entity that ultimately holds title to the property. It's the wrapper around whatever the property that we're syndicating. And for most people on the 1031 side or the investment syndicator side, it's all fractional ownership. I know that on the liability side, people might use it for personal use for their own property, but we're using it for fractional ownership purposes. And the reason why we use the DST is ultimately in 2004, the IRS blessed that structure or that entity for like-kind investment purposes. And as you guys probably are familiar, if you just have an LLC or a general, investment entity, you could 1031 exchange in and out of it, but all the partners have to stay together. In most cases, I'm sure there's some structural ways to get around that. But in most cases, if there's a group of 20 investors and then that property sold, everybody would have to move with that LLC or whatever entity to the next property to not have a taxable event for the entire partnership, unless people were bought out previously to that. And so the DST, what that allows is the group of investors, whether it's 4 to 100 investors, when that property is sold, whatever the business plan was within that syndication, it now allows everybody to do a 1031, but most importantly, go their own direction. And so all the different, quote unquote, partners or investors inside, they may all roll into another DST, they may tax out, they may, if there was a 721, which is this UPREIT structure you guys are referring to, then they'd take that option if it was available. Or at that point in time, they just may have a property they want to buy on their own, so they can go 1031 into that. And so that's what's unique about the DST structure. The other things about the structure, I'm sure you guys are familiar with tenant commons. In a lot of ways, it's the same concept, except the biggest difference between a tenant common and the DST, one, there's virtually no minimum investment, where a tenant common, if you're buying a $35 million property and you have 35 investors, technically it's $1 million minimum investment, right? Or however it balances out as you're raising capital, but it's usually much higher chunks of money that an investor has to put in a particular deal, where the DST, generally a sponsor will have a minimum investment of 100 grand and sometimes as low as 25 grand. So it allows investors to diversify their funds and not be so over concentrated in one particular asset, which is, in our opinion, very important in today's market for someone who wants to be kind of a passive investor. And then the other unique thing with that is, for people like yourself, you may be more sophisticated, right? I heard, Chris, you close on a couple properties. You may be a hands-on investor or more in control. And so we work with a lot of people like that, where they'll utilize the DST for like either a backup strategy or a cover strategy. So as you guys know, with the 1031, there's the, ticking 45 days, and you may not be through your due diligence or your financing, whatever it may be. So the DST you could put as a backup on your identification if it fits within the rules. 9 times out of 10, those investors don't utilize us. It just was a safety net for them, but it does happen where a deal blows up. They find the skeleton in the closet, or financing gets retraded, whatever it might be. And then the cover would be if you had a $10 million exchange requirement and you found the perfect property at $8 million or $9 million, you can use the leftover funds into DSTs to then have a full tax deferred exchange. So you can kind of blend it into the mix. What I see a lot of investors doing now is utilizing, I know that the presentation here was kind of targeting initially debt-free DSTs, but we do have DSTs with debt on them as well. And so a lot of people will utilize this for the debt component, because that's another difference between the TIC and the DST, is the DST investors do not have to qualify for the debt. They don't have to sign any loan documents. They don't get it on their credit. It's just the debt gets assigned from the tax purpose or the pass through the Delaware Statutory Trust. And so sometimes investors in today's market where interest rates are really high, we syndicated these deals, or some of our sponsor partners syndicated the deals, 6-12 months ago. So debt, the interest rates are much lower. And so that's an interesting approach that I've seen more popular over the last 12 months. And then the other difference with the TIC and the DST is TICs had voting rights, which can be good in some cases. All the investors, get to vote on big decisions, but it can also be very bad. I mean, I was around the space in 2008 cycle, and you might, Chris may be the original investor in that TIC, but he passes away and now someone else comes in that knows nothing about real estate. Now they're voting and they're causing trouble for the other investors. And there was a lot of decisions that, unfortunately made a lot of TICs blow up in the past. So it's important to understand who your sponsor or trustee is on the DST, but they are the ones who make the ultimate decision. And they're the ones who sign, if there's a loan, their name is the one on the loan. So they have any carve outs or things along those lines. Before I go further, are there any questions kind of from a structural standpoint that I could address? Brendan, you want to go first? I saw your
Oh, I think Chris had his hands up first, but my question on the tick with a larger minimum investment, is that because there's a smaller number of investors that can be in a tick, or do they have to all have an equal share?
It's
Or is
no,
it
it's just the number. So the 35 number. So yeah, investments as you're raising capital, the investment minimum could drop, as you're raising, because maybe an investor comes in with a $5 million chunk and it allows another investor's minimum to drop now, but we just can't go, if we're using the tick structure, we just can't go over the 35 number.
Got it. Thanks.
Yeah. Chris, did you have a question there?
I did, but what you kind of shifted to, does anybody have questions about the structural? And my question was a little more broad based. And you'll probably answer it later, but it's just more about what you guys are typically investing in, because I see most DSTs are investing in commercial property, and I'm just really skittish about commercial property investments right now. So I figure that's going to be part of what you're going to talk about.
When you say commercial, you're referring to just across the board or a certain asset class, like office?
That's fair, because multifamily is really considered commercial.
Yeah.
Multifamily, less skittish. Commercial, really skittish.
Yeah. So we have in the past, and kind of what we focus on or within our different kind of criteria, we do all your commercial stuff, and you're absolutely right. Some investors, they may just not be comfortable with it, and that's why we try to have options, right? We try to, if you were to look at our menu, we try to accommodate our investor kind of pool we have out there that is more likely to be interested in the DST vehicle. The closest thing, I mean, it's still kind of institutional level, but we have done like single family house portfolios, but they're typically still institutionalized. So it might be like a portfolio that's bought off Toll Brothers, right? Or something, some big home builder. So it's still community. And the reason why we target stuff like that is the economies of scale and management purposes versus having because we need to build a portfolio that's at least $5 million of assets, or it doesn't make sense to bring out the syndication, because we got to, as you guys know, all syndications have a cost to them, fees. So we need to have a certain scale, because certain fees are fixed, like an attorney prepping a PPM or prospectus, like it's a fixed cost. So the smaller the deal, that larger that fee percentage is, right? So we try to, on average, most DSTs are anywhere from $15 to $50 million syndications. So you might have I think we have 2 portfolios that are rounding out right now that were bought from a home builder. So it's, it's a big acquisition of, 30 or so homes. So I guess that would be the closest thing that might be considered non-commercial or typical, but it's kind of ran like a multifamily because they're all in the same neighborhood or track. But to offset that a little bit on the commercial side, 90% of what we do is not your, typical, like what I'm sitting in an office building with a bunch of random, tenants, good businesses, but, individually owned or local businesses. We're trying to target investment grade type tenants. So we do a lot of like logistical buildings. So we have, FedEx distribution centers, which, they'll sign a 10-year lease. So we'll buy them anywhere from 5 to 10 years on the primary term. FedEx, obviously it's 50-50 when the renewal comes up, but they do have a 90+% renewal rating, right? So we're trying to target stuff that we have a healthy chance of renewing the tenant. And if we don't, we have a healthy chance of a re-tenant, right? So if it's a logistics building, we want to be in a good thoroughfare. There's usually low vacancy in a lot of logistic thoroughfares because you can't build logistics everywhere. There's less areas in a city that you can build it or that it's zoned for it. So we're trying to, have those barriers to entry when we're looking at different asset classes. Now, on the flip side, in today's market, because of what you just said, the skittishness of commercial real estate, the uneasiness of what direction things are going, there's a lot of opportunity that's evolving, right? So we call that the low-hanging fruit. So if you came to us, and just so you guys know, we represent a lot of sponsors, but we're also a sponsor ourselves. We have a sister company. So when I say this, I'm saying it from from a sponsor perspective. If you came to us 3 years ago when the market was humming, we were never going to buy, let's say, a shopping center. It was just cap rates were too compressed. Pricing didn't make sense. And we were targeting something different. Now, because lenders are skittish, sellers have loans coming due, we're targeting a lot of shopping centers where we're getting a good basis, well below replacement cost, but still good fundamentals in those centers, right? So that's the risk reward, why it might make sense now. And then to further that, we buy them debt free. So God forbid you have those moving parts, a lease renewal, bankruptcy, whatever it is within one of your tenants. Yes, distributions could be affected for investors. We're never guaranteeing distributions, but we don't have a catastrophic issue. It's just, hey, let's reposition the asset. One more thing I'll add to that before I open it up again is a DST structure. One thing that you can't do as a sponsor inside the DST structure is a capital call, which in a TIC you could, right? That's another big difference. And so when you're doing that, we have to pre-capitalize reserve. We budget for the rainy day as well, right? The uncontrollable event. And so that's a nice thing to have capital. What we see, some of the centers that we're targeting right now on the retail side, for instance, or some of the commercial buildings, is the owners ran out of capital. A lot of owners over the last decade, when they needed to infuse capital for a value add program or a re-tenanting program, there was easy access to outside capital. You could go get a bridge financing, you get construction financing, all the different, routes, private lending, et cetera. A lot of that has, gone down dramatically, or the rates just don't make sense anymore when you look at that. So owners have good properties, but they don't have the continued capital for all the deferred maintenance and, keeping the property stable and not becoming a zombie location. And leasing brokers are very aware of that. Anytime we're out there advertising space or pitching leasing brokers, the first thing they ask us is, how much do you guys have for TIs allocated? What do you have? And you'll get blacklisted immediately in a market if you are not well capitalized. And so the DST structure really allows us to have that security as an operator, because we have that $2 million set aside in an escrow account or whatever day one. And it allows us to move fast on it and avoid ever going to the investors and saying, hey, we have, Amazon wants to move in our spot, but we need to raise $500,000 for a TI plan. So that's I think a unique aspect of the DST. Any other questions? I can jump into the 721 stuff, but just anything.
So is it locked in? I mean, if you can't do a capital call, are you able to add additional investors, which may not be a capital call, but might dilute the current investors' share if you needed capital?
Yeah, so there are mechanisms that you can do. For us, like my entire portfolio that I manage as a sponsor and that are part of, we have a couple million square feet and all of our stuff's debt free. And so the unique thing for us is, God forbid, the reserve account doesn't cover whatever is needing to be done. We will have a lot more options out there for unsecured financing than someone who had a property with a 60% loan to value, because we are very much more secure to that lender. And then also for us, we have internal capital. We have an internal fund that we've raised we to date never had to tap into it, but we can essentially, as a sponsor, front that capital. We would be owed it back, but that would be one way to do it as well. For someone who has a loan on the deal, and we work with those deals, not saying they're bad, but you do have less options. So that's why we're very big on, when an investor does need to take on debt, because it's a requirement of their 1031 exchange. Really understanding that deal, are there enough reserves, or is the sponsor skinning it out to juice the cash flow to, try to attract investors? What does their pro forma look like? So you got to really dig into those deals to understand them. For instance, right now, I think in our space, there's probably 50 to 60 active DSTs that, plus or minus utilize debt. We probably have less than 20 of them on our platform. So there's a lot of, debt structures we won't work with, or just deal structure in general.
I'm going to ask you a question here.
Yeah.
Well, first of all, I want to say I thought your background was fake until I saw somebody walk by. It's a beautiful office, by the way.
Oh, no, yeah.
But two is, can you give us a sense? I guess every DST is different of what kind of returns to expect. And is it typically a monthly cash flow? Is it typically an IRR where maybe it's a small cash flow, but there's the resale at the end? Or how do you guys typically structure it in terms of? And I hold you to nothing, and I appreciate that this is not the fairest question to ask.
Yeah, no. So all DSTs in general, and not just us, all sponsors will pay monthly. I'm not aware of any sponsors out there that don't pay monthly. And in terms of returns, if you look at the industry and different deals, like you just said, some are more IRR focused. So I don't see as much of that in today's market, but there might be a value add or repositioning plan. So the current cash flow is lower versus maybe something's more of just a fixed income play. And those are going to be more like your triple net leases, right? You have a FedEx with a 10-year lease. There's not a lot of moving parts there. But the cash flow ranges right now are generally between 4 to 6.5%. Usually when we're creating a diversified portfolio, the average cash flow could be anywhere from 5 to 6%. And it's really going to be investor to investor, right? Because some investors, depending on what their entire portfolio looks like, they may want to only be in value add stuff, or they may only want to be in, kind of a fixed income kind of approach. We don't predict IRRs for a few reasons. One, it's really hard to do that. No one knows what's going to happen 10 years from now or 5 years from now. And then two, from a regulatory standpoint, we're just not allowed to do that. So our regulatory bodies are very hard lined on putting, this is a 15% IRR on the front cover of a PPM. Now we do have track records, right? We could walk you through, hey, other similar deals at these points, similar markets, this is how they perform. So that's how we walk through. And yeah, we want to try to target IRRs between, depending on the asset class, 8 to 15%. We had incredible returns over the last 3 or 4 years, like everybody probably, in the high double digits. But in reality, that probably is not going to be a fair way to look at it, at least over the coming years. So our goal is to protect principal, provide. DSTs are not for home runs. That's really for the hands-on investor. We're trying, most of our investor profiles, just trying to get a consistent income or whatever the income was stated to be. So
thank you. Appreciate it.
And then I'll address the 721, but obviously if any random questions come up, feel free to do so. But as Chris was mentioning earlier, and I think maybe Brendan, there are, and it's becoming more popular, there are a lot of DSTs where the business plan is essentially to be upreated. So upreat's a term that you might see, or 721 exchange. Essentially, that's something in the tax code that allows a property, and this is any property, it's not just DST. So you could own a property and a REIT comes by, or a non-traded REIT, or a fund comes by and says, hey, Jeff, I want to buy your FedEx building for, X amount, $10 million. But if you want to come up into our fund or our REIT, we'll give you shares, operating units of our REIT, and you just contribute your property. And that contribution is a 721 exchange. It's very similar to a 1031. You get deferred into there, so there's no tax consequence. Once you go into that fund, REIT, non-traded, whatever the structure is, there could be liquidity features, which Chris, you mentioned earlier. If it's a publicly traded REIT, then yes, absolutely, there's liquidity day one, right? Because it's publicly traded, unless there's a some sort of year or two restriction on you.
Can you tend directly into a publicly traded REIT? You can't do that, can you?
No, not 1031, but yes, you can 721.
Okay, maybe I need to understand the difference, because so is a 721 is that from the DST to the REIT?
It can be, but a 721 vehicle could be done in theory on any property. It's not just unique to the DST.
It has to be, but you have to be contributing that property to the REIT.
Yeah. So instead of if you were the owner of that building that was contributing, instead of taking cash, like the $10 million, you would get 10 million of shares or whatever their valuation.
But if that was not the case and you weren't contributing it,
then you get $10 million.
Not like kind, you wouldn't be able to move directly from property to a REIT that include that property, right?
Exactly. Yeah.
But
no, you're right.
If you put a DST in the middle of it, potentially.
Because it's the same theory, because the DST is still one property that you just happen to be a fractional owner, but that property is being absorbed or contributed to the REIT, and then you opted in for shares. Now you're diversified because you own shares, but that's what the 721 mechanism is. Does that make sense?
So yes and no for me. So let's say I have a property. I'm selling the property. I want 1031, and I want to go into a DST. So the DST is not buying the property. It was my understanding that you could 1031 into that DST, and after a period of time, you could upread it. Is that
correct? Yeah, no, you're right, because you went 1031 of your personal property to the DST. So now that original property is gone. You sold it, right? And now your funds are in this new DST. So now that's your new property. Now that new property is being contributed to the REIT. You opted in to contribute. Now, you could take that middle DST out. Maybe that REIT wanted your original property and you would have been directly in the REIT day one. That's usually not the case, because most REITs don't just buy properties off, the street. They're usually institutionally bought, but it could happen. I have seen that happen before. We're doing that on a fund right now where we're gearing up. We have a fund that has liquid capital, where we're going to buy distressed buildings. We're going to approach sellers that have loans coming due and ask them, hey, you have a loan coming due, your valuation's at 60 cents on the dollar right now. You can either lose the property because you're going to fire sell and all of your money's going to pay off the loan, or you can contribute your property to our REIT. We'll be the rescue capital because we have capital to bring that zombie building back up. But you'll be a different class of shares in our fund, right? You don't have the same preferred as someone else does, but hopefully it stabilizes and it benefits everybody. So there is that, in down markets you'll see that happen more often. But the general for the DST, getting back, is yes, a lot of DSTs have the business plan of being upreated or 721 into some sort of other vehicle that's controlled by that sponsor or affiliated with the sponsor. So it's like a predetermined business plan. So you would know that was happening before you invested in the DST. And then some DSTs are forced, meaning once you go in that DST, you're going in that upreat no matter what. You're going to be disclosed that day before you invest, but we call that a forced, 721. Then other DSTs will have an option, right? So they'll let you know, hey, this property is going to be sold most likely to this affiliate, but when we go to sell it 2 years from now, we'll let you take your funds and go to a normal 1031 exchange if you want to do that, or you could come up in our REIT. So they kind of give that flexibility. I kind of like that better, the flexibility, because then you can actually look at the health of that REIT or that fund, 2 years from now, because it's going to probably be different than it is today. But that's kind of how it works.
Chay, can you maybe if I use numbers, it might help me understand just a little bit more. Like let's say you have an asset that you're 1031ing, let's say it's 10 million. Let's say basis is about 6. You got about 4 in gain. You put into a DST that gets upreated. If you sell some of your shares in that REIT, how does that work? Is it if it's like I said, 6 in basis, can I sell like up to 6 of it and not pay any taxes and just keep the 4 gain in there? Or is it how does that work in terms of taxable event?
So unfortunately, once you go into the 721, you get that free pass of deferring it into the 721, but you will have to pay appropriate taxes on whatever level that you liquidate. So if you sell 100 grand of your shares, you are going to have some sort of recapture capital gain, unless you hold those shares forever for your estate and they get to step up. So the reason why someone goes in the 721 is they know they're going to be a passive investor for that piece of the equity for the rest of their life. So they don't want to keep on having to be in the DST structure and every 5 to 10 years have to do a 1031 exchange. They just want to kind of invest and get their dividend and not worry about all the exchange stuff. Or 2, they have some sort of estate planning or liquidation plan where they're going to control their taxable event through the years, right? Because maybe at different, whatever their attorney suggests, but there's different tax rates at different times, and then they're going to liquidate, so that's why. But there will be a tax of some sort if you do liquidate.
Okay, and I'm sorry I'm getting kind of granular here, but we'll use your $100,000 liquidation of that account. I remember it was kind of 600 in basis, or 6 million in basis and 4 million in gain. So would I be, if it's $100,000, I'd be paying tax on 40 of it, or
I believe, and I'm not a CPA, I believe it's pro rata. I believe that it's pro rata when you're doing that. Okay. From what I have heard, and I think that's why when they're doing that kind of planning, because they have kind of control that a little bit. The only what's that?
No, please, you continue.
No, I was going to say the only other thing I could think of is if a REIT did a refinance, right, and then they gave special distributions off that would be tax free, but not if you purely liquidate.
Yeah, no, that's one of my favorite ways to get money free, is just well, especially when money was free to borrow. I mean,
totally. Yeah.
Borrow it instead of selling. I mean, it's just some of my biggest deals. Borrow against the stock portfolio, and you have ready cash.
Exactly.
Yeah. Not as easy today.
Yeah.
A little more painful today. You guys work with retirement?
Any what? I'm sorry.
Retirement accounts?
We do. There's limitations on, but it's more of an internal thing on the sponsor side, and I don't remember the number off the top of my head, but we can only take so much per issuance, but we can accept them for sure. And that's the other thing I didn't address. You bring up a good point, is all DSTs, which is getting much more popular today, or at least over the last few years, are available for cash investments too. So it's not just 1031 funds coming in. And the unique thing there is if you're a cash investor into a DST, when that DST sells, you can now 1031 exchange. Where if you're just a cash investor in some, other syndication or LLC, when that sells, there's going to be a taxable event. You can't 1031. And so we're starting to see more investors from a cash investment standpoint utilize our, vehicle for investment purposes, and the fact that they can just do small chunks, right? Like, I got 100 grand that I'm gonna pull out of stock market, I'll put that in there, or like you said, a retirement account, whatever it may be.
I have a question on like the time that you could buy into a DST. Is that typically just at the beginning, or do they take new investments during their period? Say I have $1 million building, wholly owned. I want to diversify it into 5 different 200K investments, but have exit dates that are staggered out over a number of years rather than them all coming due in the same year. Can I, if the expected hold is like 5 years for a DST, is there one that is a year into it and another one that's 2 years into it? Or do I have to look for something that's looking at a 5-year hold and a 6-year hold, et cetera? And I understand may not be guaranteed, but
yeah. So I'll address a few things there. Let me know if this answers your question, but because it brings up a good point. So number one, what I didn't mention is the way or how a sponsor and investors close into the DST and how it's acquired, or the property is acquired. And so this is the big difference in the TIC world. A lot of TICs out there, syndications, will identify a property, tie it up, and then try to go out and raise the capital to then close on it within whatever the contract, dates were. With the DSTs, at least all the reputable sponsors, they will close on that asset with some sort of capital. For us, we put it on our balance sheet. So we technically temporarily own the unsold interest in that DST on our balance sheet. So we're collecting the rent, while we're waiting for an investor that wants that property. But the benefit to the investors is when you're ready to close, if you have your exchange today, you can close into that DST and not wait for us to raise all the other capital across, because depending on the size of the DST, it could take anywhere from 3 to 12 months to raise that capital. And so it really reduces the risk of having a failed exchange. And then also you just not sitting on your money and not making a return. And then to the part on your question, if you have a portfolio of real estate, which I think is what you said, and it's all going to sell at different times, it's most likely, if it's something that's 2 years from now, like you sell property A today and then property B is 2 years from now, that same DST that property A went into, it's probably gonna be closed out because it's not an open-ended fund. If we buy a property and the offering size is $10 million, once we raise the last 10 millionth dollar, we close that DST and launch the next one. So it's a matter of just having the conversation with us. Hey, what's your pipeline? We know what our pipeline looks like, usually 3 to 5 months in advance. Because like I said, we're buying the property today, but we're not launching it because we're going through all our due diligence and contract escrow period. So just communicating with us as you have a sale or before you list a building, we can kind of give you a good idea of what the market might potentially look like. Does that kind of make sense to your question?
That makes sense. It wasn't quite the answer to my question, though. Say I have $1 million of potentially taxable equity, or of gain. I don't want to realize that in 1 year and have a massive tax thing. But say I'm looking at, I do want to realize this gain, but I want to realize it over a 5-year period. Can I find a DST that's going to exit in 2 years, one that's going to exit in about 3, one that's going to exit in about 4, et cetera?
Yeah. So the short answer is, or two parts that, yes, we could try to stagger the business plans, right? Because different DSTs will have different kind of hold periods. The only caveat there is we're a trustee, right? So we have a responsibility. So yeah, we might have a business plan for 3 years, but if the 3rd year ended in 2020, COVID, and it was at the bad time, we're not going to sell that building, right? And because it's not a appropriate thing for the trustee to do just because it said that we were going to do it at the time. So we usually
I totally understand that wouldn't be a guaranteed thing, but
there is that ability to stagger, and then probably throwing in some of that where we know the 721 exchange is going to happen, and having you go into ones where you're potentially going to have that option to just tax out at that time, because 721s are generally more hardline business plans. Like we know they're probably going to happen between years 2 and 3 or whatever it is. So it's possible to get pretty close to what you're trying to attempt, as long as you understand there could be a couple moving parts there.
Sure. Okay.
Jay, I missed which company that you're with.
So we have, and I mentioned this at the beginning, so K Properties and Investments is more of like a capital markets group, right? So we're out there, we have a full team that interacts with different investors or investment groups and just educating. And the reason why is because in our world, we're regulated by the SEC and FINRA. And so these syndications essentially get passed through or transacted through a broker dealer. We're not a broker dealer, but we have to hang our licenses under a broker dealer from a regulatory standpoint. So that's kind of the K Property side, representing, you know, the wide market of the major players, because all those DST sponsors don't go, in a lot of cases, can't go direct to the investor. They got to go through that broker dealer channel. So unless a sponsor has their own broker dealer, they utilize firms like K Properties to raise capital for them. That's how we got our start in the industry. So Dwight K, our founder, has been in this space for almost 2 decades. And the first decade, primarily just raising capital. But both Dwight and I come from a real estate standpoint or an operating standpoint prior to kind of jumping into the DST space. And so in the last 10 years, we saw for a missing piece or missing niche in our market, which was the debt-free DSTs. And so that's why we have mentioned our sister company, which is Cove Capital Investments, that structures DSTs and is a sponsor of different real estate programs. But 99% of what we do on that vertical is debt-free. So when we have clients on the K Property side, wanting to be more defensive, or they don't need to take on debt, or whatever the reason is, we have options. Because 10 years ago, there was one sponsor doing debt-free deals out of everybody. And that sponsor might have done them twice a year. They weren't even prolific in it. And so we just saw the missing piece there to jump in. And but we still work with all the other sponsors because we're big on diversification.
They don't most people come to you with debt on their property? I would assume so.
No, it's actually, I mean, yes, a lot of people do, but remember, a lot of them. So I'll answer on 2 parts. Historically, our investor profile was more an investor that has managed property on their own for 20, 30 years. They've paid off a lot of their debt. They weren't doing all the refinances like you. They just kind of, manage their asset. Now they want to get out and be passive. So that was a big, in the front end of the DST industry, that was like the big pool. A lot of people were either very low leverage, like 20%, 30%, because they had so much asset growth, right? Appreciation. And they just were riding their old loan or old loan balance. So we would cover their 30%, but then the remainder of their debt equity, we would blend in the debt free. So yeah, we would always have clients with debt, but it's usually not like they're not coming to us with 70% loan to values. So that was the big thing. And then in today's world, though, a lot of people don't have debt. It's kind of surprising. It's just they either have paid it off for the years, or they were with a group of people, or whatever it may be. But 50% of our business, maybe 50, 60, still utilizes debt. So it's not like it's overwhelming, but people are scared today, right? So it's a unique way, especially for cash investors. Cash investors, well, if you want to get any quality building, it's going to be, generally speaking, unless you're buying like a single family house, it's going to be a couple $1 million. You may not want to put your entire nest egg investing in real estate, buying a $3 million building. So they can utilize us to be that real estate piece of their portfolio, and then also be debt free, knowing we're not going to get foreclosed on. We always disclose we could lose cash flow. We don't have control over a tenant per se. We do our best, but the reality is cash flows can go up and down. And that's why you also diversify whatever you're going to allocate with us, so that if one out of everything's staggered leases, so if 1 out of 5 doesn't renew, you don't go to 0% cash flow. but 1/5 your income's gone or whatever it may be.
Yeah, I have a related question. So if I'm at, say, a 50% debt ratio on my 1031 and I go into a DST, when that DST exits and I roll into another DST, do I have to roll that into another one that has about a 50% debt on it?
You would. So once you have debt, you're kind of stuck with debt, right? Or in that requirement. The only way you can get rid of the debt is, well, if there was appreciation in that situation, maybe in theory your loan to value is lower because that loan to value is different on that next exchange, but that principal balance is the same. Or if you had prepayment, just amortization take place, yeah, your loan balance might be lower when it goes to sell, but you still have some sort of debt component. Another strategy that we've been doing in the recent times is we have some of our DSTs, it's none that we sponsor, but we work with another sponsor that does very high loan to value DSTs. So they'll do Amazon distribution centers or like a government backed VA hospital. And they have the ability, because of the security of a 20-year lease with a tenant like that, to get 86, 87% loan to values. So there's no cash flow on those deals. But if someone puts in 100 grand into that, they just absorb, 700-800 grand of debt, right? So it's a huge amount of debt. So when someone comes to us, we could put a little bit of their equity into that zero to absorb a lot of their debt. And then it opens up the rest of the equity to be in the debt-free product. And it's not a 10-year loan on that deal. So it's not, the loan is usually in conjunction with the lease. So it's like a 20-year loan, which is a lot different than the most commercial loans. So it insulates that debt risk into that Amazon or into that, whatever the, kind of investment grade tenant might be.
That's clever.
So that's kind of how that's a unique strategy in today's world. And some sophisticated investors will just utilize us for the zero, and they'll go buy a property on their own with the rest of their. We had a hotel developer just sell a hotel for $100-something million, but he had $50 million of debt. I don't remember the exact number, but a very large amount of debt. And in today's market where debt doesn't make sense, so he identified I don't know if it was $5 or $6 million worth of the zero, which bought him a ton of debt. And then he could use that rest of the equity to go buy his next project debt free.
Cool strategy.
Yep. And then debt free too, to address that for sophisticated investors that generally, where debt could make sense for them, is it gave us a lot of flexibility over the last few years to exit deals early. So as you guys know, most commercial debt has some sort of prepayment structure or defeasance or whatever it may be. And so if you just bought a deal in 2017 and had a 10-year financing on it, and then a off-market offer came, or the market was going nuts in 2021, you might not have been able to sell it because once you took the prepay hit, it just ate into all your profits, right? And it doesn't make sense. Where for us, we were able to take advantage of that market because we didn't plan on selling a few deals. We did exit deals that we had planned to hold for 5 to 10 years in the year 2 or 3 for healthy profits because we had that flexibility. And then to address Chris on the commercial stuff, we're very in tune with the markets where we can be. We had another asset where we were doing a kind of like a quarterly interview with the facilities manager, and we kind of got wind that the employees were worried that they were going to get transferred to another location in the MSA, which kind of gave us a little nervousness that they weren't going to renew the lease a handful of years down the road. And so we listed the property. We're debt free. We don't have any prepay, and we sold it for a profit while we could, right? So it's not just about avoiding foreclosure. There's other flexibilities that come with that debt-free nature.
What's the current password for your website? It tends to expire every now and then.
Yeah, I don't know it off the top of my head, but if you have my email, I can have someone send it to you. And also we have a reoccurring list that maybe you're just not on, that when the new password's created, just gets sent out. So sorry that you're not on there, but my email, so anybody can email me and then I'll make sure whenever you respond to get you whatever info you want. But it's just my first name. So it's the CHAY and then at KPI1031.com. So K as in kite, P as in Paul, I as investment. So KPI1031.com. So feel free to email me. I can respond with all my personal contact, and anybody can reach out with questions in the coming years.